Adani Power is a behemoth. With an installed capacity crossing 18 gigawatts, it is India's largest private thermal power producer, commanding a market cap of roughly 4.1 lakh crore rupees. Over the past 12 months, the stock has rallied roughly 96. Adani Power operates 18.15 gigawatts of thermal capacity across 13 physical assets. It is the primary private entity answering India's surging baseload power demand. 95% of operating capacity is locked into long-term power purchase agreements, leaving a 5% sliver exposed to the merchant market. Management targets nearly doubling this footprint to over 30 gigawatts by 2030 and 42 gigawatts by FY32 through new construction and acquisitions. The primary buyers for this electricity are state distribution companies, or DISCOMs. Relying heavily on a few government clients creates customer concentration risk, but the sovereign backing of these entities heavily mitigates the threat of an outright default. By locking down operating capacity through PPAs, Adani Power sheds the risk profile of an energy trader and operates as a predictable, utility-like cash generator. This earnings release details the historical baseline heading into the current fiscal year. In fiscal 2026, the company generated 105 billion units of power, yielding over 21,200 crore rupees in continuing EBITDA. Performance accelerated sharply in the first quarter of fiscal 2027. The company reported a 47% year-over-year surge in profit after tax, reaching 4,867 crore rupees. Q1 total reported revenue hit 19,322 crore rupees, flowing down to a quarterly record continuing EBITDA of 6,983 crore. Zooming out, EBITDA margins have expanded to 42%. By mapping enterprise value against earnings, we see the market is paying today for the flawless execution of their 42-gigawatt expansion by 2032. The underlying profitability does provide structural support for these multiples. The business currently generates a return on equity of 21.1% and a return on capital employed of 17.2%. But paying a premium multiple for a capital-heavy business leaves zero margin for error. Management must hit their capacity timelines perfectly, or the stock risks a severe multiple contraction. Because paper profits must fund physical capital expenditures, we have to audit the actual cash generation. This chart compares profit after tax against cash flow from operations. We use this ratio to verify how efficiently reported net income actually converts into bankable liquidity. The primary friction point in this conversion is the working capital cycle, specifically debtor days. State DISCOMs frequently delay payments, which can trap a power producer's cash in outstanding receivables. A forensic check on auditor fees confirms they are scaling proportionally with revenue and profit growth. There are no sudden spikes to suggest accounting irregularities. Cash flow velocity is the lifeline of this business. Collecting payments on time from state governments is the only way Adani Power can self-fund its massive infrastructure pipeline without dangerous levels of new borrowing. Power generation requires immense capital. Building and expanding physical transmission and thermal infrastructure demands both deep institutional backing and significant leverage. The shareholding structure is highly concentrated. Promoters hold approximately 75% of the equity, leaving a narrow free float contested by domestic and foreign institutional investors. The percentage of promoter shares pledged as collateral remains a vital health indicator, serving as a proxy for the broader liquidity of the Adani Group. This chart overlays the balance sheet leverage against operating earnings. At the end of Q1, net debt stood at 47,642 crore rupees, but the rapid ascent of the EBITDA line is aggressively compressing the overall debt-to-equity ratio. While the absolute debt load remains a significant obligation, the current cash-generating ability allows the company to service this leverage more comfortably than in previous cycles, reducing the immediate threat of a balance sheet crisis. On the trading floor, the market is actively processing this fundamental data. After doubling in value over the last 12 months, the weekly candlestick chart shows price action flattening into a consolidation channel. Overlaying moving averages, the 150-day sweeps in from below to act as the primary structural support. Compared to peers like Tata Power, Adani's pure thermal strategy yields higher sector margins, though it lacks the hedge of a highly diversified renewable portfolio. The technicals indicate a necessary cool-down period. The price action is consolidating to allow the underlying business growth to catch up with the valuation. Projecting to 2030, the most severe headwind is ESG compliance. The company's operating assets are heavily reliant on raw coal, in an economy under pressure to decarbonize. To secure clean, baseload power against future regulatory shifts, management established Adani Atomic Energy, targeting 10 gigawatts of nuclear capacity by 2035. Moving forward, the return profile depends on execution. The bear scenario models construction delays and discom payment defaults. The base case delivers the promised 30 gigawatts by 2030. The bull case requires hitting 42 gigawatts while simultaneously widening EBITDA margins. The math for an investor buying today is highly rigid. To achieve a 15% annualized return, the company must effectively double its fiscal 2026 baseline earnings just to sustain its current premium multiples. Based on the 360-degree audit, the verdict is a hold. The cash generation and capacity targets are robust, but the market priced the stock for perfection. For new capital, the numbers suggest waiting for a technical pullback closer to the 150-day moving average.